Okay, in this chapter we're going to have an introduction to the topic of risk management. Now, we're by no means going to cover every possible risk management technique that a company might use. However, we are going to look at some of the most common techniques that might be used involving derivatives to manage the risk that naturally arises as a result of a company's business operations. With any firm, the profit is measured essentially by the revenues that it collects from what it produces minus the cost of its inputs. And of course, the higher the revenues and the lower the cost, the more profitable that the company will be. Now, sometimes the revenues or the cost might be dependent on the price of a certain commodity. And that, of course, is going to depend on whether the firm is a producer of that commodity or a user of that commodity. So we're actually going to look at both viewpoints. But a company that actively uses derivatives in order to reduce its risk with respect to the price of those underlying commodities, that firm is engaging in risk management as we have defined it. All right, we're going to start off by looking at a company who produces a certain commodity. And we're just going to follow the example that's in your text about a company called Gold Diggers. As its name implies, Gold Diggers is a gold mining firm. And whenever the price of that commodity, namely gold, is higher, then the company's revenues, and hence its profit, will also be higher. That's assuming no change in its costs. So we're holding all of those other factors constant, other than the price of gold. All right, we know that the company's profit will depend on the price of gold, and obviously the company's hoping that gold increases in value, but it doesn't know exactly what's going to happen. And in fact, let's take a look at some possibilities. Notice that the price of gold could be any number of things. Let's just say for this particular example, regardless of the current prices of gold, let's say that the gold price could be anywhere from $350 to $500. And let's just look at this in $50 increments. Well, the company has already committed to producing a certain amount of gold within a year's time. And it will sell that gold at whatever the going market price is. Now, the company also has fixed and variable costs that don't depend on the price of gold, and based on the amount that's going to be produced, the fixed cost will be essentially $330 per ounce, and the variable cost will be $50 an ounce, and so that'll add up to $380 an ounce, and you can add that together. So essentially, assuming there are no other costs going on and no other revenue sources, Gold Diggers' profit is going to be the price of gold per ounce minus $380, and then whatever that is, of course, multiplied by the number of ounces that they produce. So if in a year's time the price of gold is over $380 an ounce, Gold Diggers will make money. They will have a positive net income. But if it is less than $380 an ounce, which is a possibility in this scenario, then Gold Diggers will lose money. So there's some uncertainty here about exactly how much profit the company will earn, and in fact, even if the company will earn a profit at all. So some of the techniques that might be used to help the company's shareholders sleep a little bit better at night and not worry so much about the risk include selling forward contracts. Alternatively, the company could buy put options on gold, or they could use collars, and we'll talk about some of those strategies as we go along. The first strategy that I'd like to examine is using a forward contract on gold. We already know that the company is going to produce a certain amount of gold, a certain number of ounces. We also know that its production costs essentially average out to $380 per ounce. And so the firm is hoping that it can sell for more than $380 per ounce in a year's time, but that is uncertain because the price of gold could be either higher or lower than that. So one very simple way to hedge would just be to use a forward contract and lock in the price right now. That way you don't have to worry about any of the fluctuations between now and then. For example, gold diggers might agree through a short forward contract position to sell gold, the quantity that it's going to produce, at $420 per ounce 1 year from now. If it does that, then that effectively locks in a guaranteed profit of $40 an ounce no matter what happens. Here's another way that we could look at this. We could look at the unhedged position, and we could also add in the profit that we would earn on a short forward contract. For example, let's take a look at the case where the gold price 1 year from now is $400. Well, if we've got a $400 per ounce price of gold, then of course we have $380 in total cost per ounce, and that would be a profit of $20 per ounce if the company did not hedge. But with a short forward hedge, remember, the payoff on a short forward at expiration is simply going to be the forward price of 420 minus the spot price at expiration, or 400 in this case. The difference between 420 and 400 then is of course just $20, and then the unhedged profit of $20 added to that gives us $40. Now, sometimes a hedge will work out very well and sometimes it won't. Sometimes a year from now you'll be glad that you engaged in that risk management strategy, and other times you won't. In this case, it didn't make too much difference. Alright, let's look at another example. Let's look at the case where the gold price ends up at $350 per ounce. In this case, how would things have turned out if we had not hedged? Well, we still would have had $380 in costs per ounce. So the result would have been a net loss, $350 minus $380, or losing $30 per ounce. Obviously not the outcome that we were looking for, but the short forward position saves the day in this case. You see, the short forward payoff is $70. How do I know that? Well, the short forward payoff is always the forward price minus the spot price at expiration. So it's that $420 forward price minus the $350 spot price of gold at expiration, or $70. So you take that $30 loss, but then you add the $70 profit on the short forward, and you end up with a hedged profit of $40. So again, the short forward contract has locked in a profit that wouldn't have existed otherwise. Now, I don't mean to imply that hedging always works out well. Sometimes it doesn't. Sometimes you may end up in a case like this one. Let's say that the price of gold ended up being $500 per ounce 1 year from now. Well, if you had not hedged, then you would have had costs, again, $380 per ounce, leading to net profits of $120 per ounce, which would be wonderful. But remember, the company has engaged in a short forward position and the price of gold ended up rising. That's going to result in a negative payoff on the short forward position. It's going to be the $420 forward price minus the $500 spot price at expiration. In other words, we lose $80 on the short forward position, leaving only $40 in profit after all is said and done. So in this case, a risk manager might end up kicking themselves because they could have had more had they remained unhedged. But remember, you have to make the decision about hedging before you know which way the price of gold is going to go. It's always possible that the price of gold could have gone down, and you have to make your hedging decision before you know about that for sure. By entering into the short forward contract, the company's managers don't have to worry anymore about what the spot price of gold is going to be on the expiration date, and they don't have to worry about the possibility of losing money on the position. Granted, they give up the possibility of making very large amounts of money, but they also eliminate the possibility of a big loss. All right, another possible hedging tool that a company might use is a put option. Now remember, as we've discussed before, that a put option gives its owner the right but not the obligation to sell the underlying asset, in this case an ounce of gold, at a pre-specified price. In this case, the strike price on the put option is $420 per ounce. So Gold Diggers is assured that they will get to sell that predetermined quantity of gold at $420 an ounce if they so desire. Now, of course, if the market price ends up being more than $420 per ounce, then the put option will just expire out of the money, and that's actually all the better for Gold Diggers, because then they'll get to sell the gold that they've produced at an even higher market price. But the put option acts as insurance against a drop in value of gold. Now, the way I've described it, it may sound like the put option is a superior strategy. I mean, the company has a choice here. They get to sell gold at $420 an ounce if it turns out beneficial for them to do so. On the other hand, if the market price ends up above $420 an ounce, well, then they just sell it at that higher price and don't use the put option. Had they used a short forward contract, they would have to sell at $420 per ounce no matter what, no matter where the market price was. So this option seems to allow for more upside potential. So it seems like a no-lose situation. You're probably skeptical at this point. There's got to be a catch, and there is. As we've learned before, it doesn't cost anything to go into a forward contract position normally. But with a put option, well, there's a premium to pay, and in this case, it's $8.77 per ounce. And with the interest that the company could have earned on the put option premium, after a year's time, that would total up to $9.21 in this case per ounce. So there is definitely a cost to this strategy. There are pros and cons. Let's just see how it would pay off in a number of different scenarios. First of all, let's look at the case where the gold price ends up being $500 an ounce. This is actually a very good outcome for Gold Diggers. $500 per ounce of gold. The company sells at that price. They still have $380 per ounce in cost for production. That leaves $120 in profits, but the put option doesn't end up being valuable in this case. So they lose the premium plus the interest that they could have otherwise earned, $9.21. But that still leaves a fairly large profit of $110.79 per ounce. On the other hand, what if the gold price ended up being only $350 per ounce? In that case, the company would not have done well if it had not engaged in a hedging strategy. As we said before, unhedged, the company would have incurred a loss, $350 minus $380 in production costs, so negative $30 per ounce. But in this case, the put option turns out to be valuable. It ends up paying off $70 per ounce. How do I know that? Well, because the strike price on the put option is $4.20 and the spot price of gold is $3.50. The difference between those two is $70, and in this case the put would be exercised. So $70 minus the $9.21, that's the premium on the option, plus the interest that could be earned over the year's time, leaves a profit on the put of $60.79. Add that in to the negative $30 unhedged profit, and you end up with a net income of $30.79. Now actually, that's the worst case scenario. Anytime the gold price ends up anything below $420, the company's hedged net profit is going to be $30.79 in this case. Notice, of course, that's lower than you could have locked in with a forward contract. Remember, a forward would have assured us a net income of $40 per ounce. So what's the trade-off? Why would we agree to possibly having lower net profit? The answer is we've got higher potential upside gains. We could end up with more profit if the price of gold increases. So that's the trade-off again between hedging with a put option and hedging with a short forward contract. If we hedge with a short forward contract, we lock in a profit of $40 per ounce, but if we hedge with a put option, we lock in a minimum profit of $30.79 with the possibility of higher gains if the price of gold increases the way that we want it to. Okay, so we've seen that insurance in the form of a put option is not free. It is costly. There's a premium to pay, and then of course you have to account for the interest that you could have earned on that premium had you gone some other route. However, there are some potential ways that you might reduce the cost of the insurance. Of course, each one of these methods is going to have its pros and cons. One way that you might reduce the cost of the insurance is by lowering the strike price on that put option. All other things being equal, a put option with a lower strike price will cost less. But that's kind of like having a larger deductible on your insurance policy. Anytime that you purchase an insurance policy on whatever it is, the company may offer you a choice of different deductibles, and the larger the deductible you're willing to accept, the lower the premium on the policy. Well, it's the same way exactly with a put option. Here's an example of different possible profit diagrams for gold diggers, considering both the unhedged business position plus the final profit that is realized on the put option. So this is actually the hedged profits for gold diggers using put options with different strike prices. Now we looked at an example where the strike price was $420, but we could have chosen a put on gold with either a higher or lower strike. Of course, if the strike price is lower, like $400, then the premium on the option is lower. However, that allows us to potentially incur some larger losses. Now that's okay if we are willing and able to accept losses of that magnitude. That's one of the decisions that has to be made when choosing a strike price for the put option if that's the type of insurance you're going to use. How large of a loss are you willing to accept? How large of a downward fluctuation in the price of this commodity would not be catastrophic to our business? The larger the loss we can accept, the lower the strike price we can use on the put option, and the lower the premium. Notice that when you're looking at each of these three graphs for the three different put options with the three different strike prices, that the same options that allow for potentially larger losses also allow for the possibility of larger gains if the price of gold increases. So, as always, there's a trade-off. It's a question of how large of a loss are you willing to accept versus how large of a gain might you possibly want to go for. Okay, now another possible strategy to reduce the cost of the insurance is to sell a call option. And in fact, this might be one thing that you could do even independently of the put option. So you could write a call option on gold, and by doing this you would receive the premium, which in this case for a $420 strike price would be $8.77 per ounce. So you would receive that premium, then of course invest it and earn interest. That would be $9.21 extra that you would have by the expiration date of the contract and by the time that you needed to sell your gold. The fact that you receive this premium and you earn the additional interest could mitigate possible losses. However, there is a problem. If you use this strategy, that is, writing a call option on gold, it does not protect against the possibility of potentially very large downswings in the price. So, to call this strategy a form of insurance might be stretching it a bit, because you don't really protect yourself against the possibility of large losses. Nevertheless, you might do something like this if you wanted to engage in a collar type strategy. This is one thing that the firm could do. For example, let's say that the company wanted to use a collar by purchasing a 420 strike put option on gold with a premium of $8.77 and simultaneously writing a $440 strike call option on gold with a premium of $2.49. Alright, well in that case, the net initial cost of that position is not quite as high. The cost is reduced by $2.49 because you're writing a call option with that initial premium. And then of course you earn an effective rate of 5% on that over a year's time, giving you a total cost plus interest of the position of $6.60. Let's see how this strategy would compare to just using the put option. Well, here you have a graph showing the profit diagram for the company hedging with only the put option, and then a similar profit diagram for the company using both the put option and writing a 440 strike call option. In other words, a collared position. As you might expect, each position again has its pros and cons. It's a question of what outcomes are you as a firm willing to accept. If you want to hedge using only the put option, that's great because your potential gain is unlimited if the price of gold increases, just due to the fact that you can forego exercising the put option and just sell your gold product in the marketplace at the market price. With the collared position, the net result looks kind of like a bull spread, and you have a maximum possible gain there. On the other hand, notice what happens if the price of gold does not go up. Worst case scenario, if you use only the put option, then you will end up with a profit of $30.79. However, if you sell off some of the potential gain, that is, you use a collar and effectively end up with a bull spread type position, then the worst case scenario is a profit of $33.40. So, the question again that you face is, are you willing to accept lower possible profits if the gold price goes down in exchange for potentially higher profits if the gold price goes up? That's the decision that you'd have to make. And those are the pros and cons of hedging with only the put or hedging with a collar. There are a number of interesting types of collared positions and similar types of risk management arrangements that you can try. We're not going to get too deep into this subject at this point, but you could try to arrange it so that the cost of the collar was zero at the beginning. So one way to set up a zero cost collar would be to buy a put at a 400.78 strike price and to sell the call at the 440.78 strike price. What you're trying to do is find a put and a call where the premiums are exactly equal to one another. Now, admittedly, that may be hard to pull off because you may not be able to find those options with exactly that strike price. But still, it's useful to look at the concept and see how you might try to at least reduce the cost of the collar. Another interesting strategy that you might try in some cases is a pay later strategy. And effectively what you have here is a type of insurance that is built so that you only pay for it if you end up needing it. This is a slightly more complex position created by selling a put at the 434.6 strike price and buying two puts at the 420 strike price. This is a little bit unusual and is an example of a type of ratio spread. The result, however, comes down to another one of those trade-offs. It results in a higher profit slightly if the price of gold goes up, but a lower profit if the price of gold goes down.